Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Hugh, welcome back to the show.
Thanks, Owen.
It's always good to chat investing with you. Today, we're going to be talking about some trends or themes or just ways that people can think about positioning their portfolios and their investments for the future. We're going to talk about two ETFs in particular that are more for kind of the here and now. And if you're listening to this episode, what you can take away from this today. And then there's a few others which are more, what I would say is more structural in nature, a bit longer term, which is how we like to invest. So that will all be coming up in just a moment. But I thought maybe some context for people who are newer to investing, looking at ETFs, maybe not for the first time, but just looking to properly create wealth for themselves over the next 5 to 10 years. There's this idea, Hugh, in ETFs of thematic investing, there's sector investing. There are all these different phrases that people come across. How do you think about this broad term that is thematic investing? And then maybe we'll just pull it apart from there.
Yeah, great. So it's a really good question because a lot of investors hear about thematic investing and they're not sure what that exactly entails. I mean, to me, thematic investing is really about capturing those investment opportunities off the back of long-term structural changes in the economy or technology or even demographics, for example. So a really good example is, the digital revolution and the advancements of technology like AI. That's become a really strong theme that everyone knows of. Everyone's very familiar with companies like, Amazon, Google, etc., building out these data centers in order to train these advanced AI models. But I guess how it sort of differs to maybe a sector or something like a fad. A sector is how investors categorize more so the economy into different buckets, such as financials or industrials. It's more of a categorization tool in my view. And then you have, things like fads that can fall under thematics. It's important to understand that some thematics do actually have long-term structural tailwinds that are supported by, good inflows, good revenue and profit growth. But you do have fads out there. A really good example is with GameStop. In early 2021, there was a meme stock mania that happened, and that was really fueled by more so hype and speculation as opposed to fundamental drivers of growth like earnings and profit. So you saw a lot of momentum go into a single stock like GameStop, and it wasn't really backed by anything. So this is how I deconstruct thematic investing more so into two buckets. One where there is long structural tailwinds behind that thematic. And then the second bucket is more so around fads and hype. And that's really driven by, momentum or retail frenzy, jumping into a certain stock or basket of stocks that are not really driven by fundamental earnings growth, for example.
I actually like the idea of GameStop. For folks that aren't familiar, it's kind of like EB Games here in Australia, where you go and buy physical video games or Xboxes and that sort of thing. And during COVID, that was a really popular thing. I think it was during COVID. I'm pretty sure.
Yeah, so early 2021 in January, Yeah,
that's right. Yeah. So we're in the thick of it. People were bored. They were on Reddit. They were just, if you go back to the original postings of what actually happened, it looks that they were just trying to blow up fund managers, to be honest, who were really short stock because they thought this GameStop company was going to go bankrupt, but it didn't in the end. And so that share price went, if people are familiar with the phrase "to the moon," that's kind of where it comes from. It's like to the moon. The share price went straight up, and some people thought that was what investing was all about. So this is really important when people are thinking about buying an ETF, and particularly one that excites them, because you need to make sure there's actual substance behind that. How would you, as someone who looks at these things every day, how do you think about what's maybe a fad versus what's a legitimate longer term trend or theme or something that's actually playing out?
Yeah, so a really good example of a really strong thematic is cybersecurity. So what we look at for a theme that's quite strong and that resonates with the investor community, not just for the year, but for longer term, is things like performance and flows. If you see good, consistent performance year over year over year, that's generally a good sign that these companies are doing quite well.
Yep.
And second is flows. If there are good, sustained flows going into these products, then again, it is really backing that thematic as well. But you do see other maybe fads out there, such as maybe a weed or marijuana ETF, or even climate energy is a bit of a tricky one. There are some funds that have done relatively okay, but that thematic hasn't really done too well. And we can go and look at those two factors I talked about. The performance of those funds haven't really kicked off, and the amount of flows haven't really gone into that direction. So I would say, those are two main ones. And also just have a look at the companies. As with any ETF, you want to look at what are the portfolio constituents? Have a look at the top 5 or top 10 names. See if you're familiar with any of them. You might not be, but they might be generally bigger in size, and they might be generating, larger, consistent amounts of profits, and also margins as well. So I would think that those are probably 3 key things to take away when you're looking at a strong thematic to invest in.
Yeah, I definitely think that's quite interesting about that third point you mentioned about like the companies, just looking at the companies themselves. Like anyone listening to this or watching this can just jump on the Betashares website or whatever the ETF you're looking at. Just jump on the website, have a look at the holdings, because ETFs are always transparent. That's what makes them so unique, or one of the things that makes them so unique. So you can actually see what's in there. And if you recognize names, Facebook, Costco, Home Depot, Commonwealth Bank, names that then you know that those companies are not really a fad. They're established businesses. You can go and visit them. You can use their services. But then you get some, as you're alluding to, Hugh, you get some ETFs that come out and they are more designed for what's popular at the time. And that can be quite risky for people if they're not, at least across the basics of what's actually happening. I'm going to ask you in just a moment to share some of the names, and some of these names of these ETFs and the kind of the trends or the themes behind them are quite interesting. You've already mentioned cybersecurity, which is one that we've talked about previously, but I'll give people a good example of how maybe, when Hugh and I have talked about this in the past, is if you're looking around at all the AI and these things that you're worried about, is that going to take my job? Is it going to do this or that? You can just go and invest in those companies, the ones that are leading the charge and are going to profit from it. So as an investor, you actually own the economy. I love that phrase. It comes from a Tony Robbins book, Hugh, which is you turn from a consumer of the economy and kind of susceptible to whatever life and the economy throws at you to an owner of the economy. And I love that we can use ETFs now to be like, I don't want just the broad economy. Like I don't want all of Australia. I want like this particular thing. And that's what makes them so unique. So AI is a big one, cloud computing, along with these other ones we're about to mention now. The first one that you're bringing to us today, Hugh, is something that's probably going to need a bit of education around it. So the ETF that I know you want to talk about is AQLT, which is the ticker symbol that anyone can go away and search. Tell us about this as a kind of trend, or why you brought this to the table today.
Sure. Yeah. So I bring AQLT for a few reasons. When we think about generally the first layer of investing is things like A200 or a broad-based market cap index, things that track the ASX 200. I think a lot of investors are fairly familiar with that. But we're entering a whole new sort of era within the ETF industry of building out what we call smart beta ETFs. What you can sort of describe smart beta as is an extension of what you used to have in A200 or market beta, what we call. So it's really just making slight tweaks to that index in order to eke out a little bit of extra return. So how AQLT does this, which is a Betashares Australian Quality ETF, you can see that the name quality is in there. So it does have a quality bias to it. We filter out for 3 main things within that ETF. And those are, companies that are still on the Australian exchange, but we want to filter out for companies that have typically higher profitability. So that's a higher return on equity. Second is generally low levels of leverage. That is, they have low amounts of debt on their balance sheets. And thirdly is the stability of those earnings, because you could be making, profit over the last year, but that doesn't necessarily mean that you're building a consistent stream of earnings. So we look at stability over a 5-year period. We have a sort of score. If you can score well on each of those 3 metrics, you rank higher. And so we'll weight companies that have a higher quality score higher within the portfolio. So for a few good examples within the portfolio that we have a higher sort of overweight, we call it, to the benchmark, is things like, or companies like Pinnacle Investment Management, Net Wealth, even Telstra and Pro Medicus. And these are sort of companies that have done really quite well over 2024. And what we saw was that the fund, or ETF AQLT, it returned 23% over 2024. That's more than double that of the ASX 200. So taking a smart beta approach, or a sort of enhanced indexing, what we call it, can really give you that additional return, but you're still maintaining that exposure to the Australian stock market. So I hope that,
that makes sense.
Explanation was somewhat clear.
Yeah. So and this is exactly what we can do now. So while you're chatting through that, I've brought up AQLT on the Betashares website. I've gone down to the holdings and allocations section. And I actually didn't know that Pro Medicus. So full disclosure, I do own Pro Medicus. It is, I think it's probably, I don't even know, it'd be the most common company we talk about on our investors podcast, Hugh, because it was the first ever company that I recommended for our members back in the day. And it's easily the best performing company I've ever had.
Yeah.
But this company, so this is about, as I'm looking today at the time of recording, about 7th in the overall holdings for this ETF. But what's interesting is that would not be 7th in the whole of Australia, right? Like
Absolutely.
That would be like 50 or 100th or something like that. So it's been brought way up just because it's such high quality.
Exactly.
Yeah. And then there's another name in there, which I'm very familiar with, which is Technology One, another technology company, does like cloud computing services and these types of things. Interestingly, Wesfarmers is the 3rd biggest, the owner of Bunnings, which it's a big company, but it's not as big as some of the others that are in there. So you still get that overall feel of the ETF, and you can just see by the names, Commonwealth Bank, BHP. These are not fads in any way. It's just like you said, it's just an enhancement over a traditional index fund. Yeah,
exactly right. And I really like your description, Owen. It retains a feel of the standard ASX 200 experience. Companies that everyone knows, CBA, ANZ, Westpac, etc. All the big 4 banks are miners. However, we're making slight tweaks in terms of the weightings. We're increasing our weightings to those higher quality companies, and perhaps reducing our weighting to companies that don't exhibit that amount of quality. So you're still getting the Australian market, but it's just a little bit nuanced.
Yeah, absolutely.
That experience.
To pad this out for people, Hugh. So you said it performed well over the last year. One of the risks that people have when they go for themes or trends or any types of something different is they can often be lured in by different like performance records and things that aren't, I guess predictable. Like we've all seen, past performance is not indicative of future performance and all that. You mentioned this idea of kind of investors being able to have more quality companies. So we mentioned those types of businesses in there. If you look through the list, anyone listening or watching, we'll see that these are quality companies. If you dig below the surface, I know that name. I know that name. I know that name. But why do you think quality, as opposed to anything else, is something that people should focus on in Australia?
Yeah. So I think quality should be focused on in Australia for a few reasons. When we think about the Australian stock market, it's quite heavily exposed to 2 sectors. The first one being financials, and the second one being the materials or the miners. Together, the big 4 banks and the miners, Rio Tinto, BHP, and Fortescue, those companies accounted for 35% of the index. Now, the financials industry, or the banks, have done very well over the last year, as we know. However, they are facing, quite high levels of valuation. CBA is trading at a price to book of 3.5 times. It's the most expensive bank in the world. And our miners, they're are facing a lot of headwinds. We export over, more than half of our exports of to China in iron ore. So we are facing a lot of headwinds in that respect. As the Chinese economy faces downturns, then naturally those miners will not benefit as much. So there is a lot of challenges that the top end of town is facing, and so that's where a quality approach can come in. We're taking a feel of the market. However, there's probably a slightly lower size bias, or what we call the average amount or the average size of the businesses within AQLT is probably slightly lower than your traditional index, because we are underweighting perhaps some of those larger cap names. And so I think investors might find value in taking a quality approach, because you're getting more consistent earnings throughout different cycles. So that figure I mentioned, that 23% of the year, if we take a step back and look at a longer term time horizon, we actually do see consistent outperformance over the benchmark over relative years, or more consistent years.
That's I remember, because we had your colleague Cameron on the show about a year and a half ago, and he started talking about this, and I was like, Cameron, just talk about A200, because everyone's interested in A200.
Yeah.
But obviously he was right.
Yes.
And it's a pretty, you mentioned, just to clarify for people too, you mentioned this idea of flows before. And so what Hugh was talking about there is the money flowing into the ETF. So this is like every investor in the country putting money into the ETF. And you obviously, the total amount invested goes up as people put more money in, but also as the performance kicks in. And it's near $400 million already in the ETF, which is significant. So that's great. The next one is quite different, Hugh. The ticker symbol for this ETF is MMKT. We've talked about this before, but with interest rates looming, we're actually recording this, not to date it too much, but on the day the RBA, the Reserve Bank of Australia, is to meet, and the consensus is for interest rates to fall. Whether or not that happens, we'll find out in a few hours after this recording. But if interest rates fall, people are thinking, well, my interest from my bank account is going to be less. How can I kind of deflect some of that? Can you talk to us about this?
Yeah. So we have our RBA meeting today, and what we've seen is that generally income is being a bit challenged in Australia. So the average term deposit rate since July of last year has come down about 35 basis points. So the average 1 year term deposit across the big four banks is now at 4.1%. And if we look at the dividend yield as well on the ASX 200, that has also come down quite a bit. It used to be 5% not too long ago, only a few years ago. But now the dividend yield is just 3.5% or around 3.6%. So you're seeing, declining levels of, interest rates and dividend yields, and investors are seeking a alternative source of income. They might have a savings account, they might have a term deposit, they might have Aussie shares with the franking, but they want something that can give them a little bit more juice from an income perspective. And this is where sort of MMKT comes into play, or the Betashares Enhanced Cash ETF is what it's called. So what it is, it essentially invests in what we call money market securities. These are just very short-term securities. So anything with a maturity of less than a year. So things like NCDs, or negotiable certificates of deposits, commercial paper, floating rate notes. Those are the sort of things that you're getting exposure to. Now, the fund, or the ETF, was launched in November 2023, so relatively short track record. But what we saw over the year to 31 January was that it returned 4.85%. And so you're getting, quite good levels of income relative to maybe other sources out there that you might traditionally have, like a term deposit or even Aussie shares for that matter. So right now, I feel like cash, is still, it gives you optionality when you need it. There are definitely a lot of maybe headwinds that markets are facing at the moment, and it does make sense to keep some in cash. But whilst you do have that cash allocation, why don't you leave it in something that's going to give you a little bit more income, giving you that extra return, and then you can deploy it into other maybe areas of the market that you might find interesting. So MMKT is a really good fund in that respect.
Yeah, it is. And it's always been one that's like up on my radar because it does kind of extend. So I know some people will be keeping up with us here when we talk about those different types of securities underneath the surface. But if you're thinking about this, like when you're lending money to the bank, that's a term deposit. You're lending money to the bank to then go and give mortgages and that sort of stuff. This is very, very similar, except it's more in the corporate world as opposed to just the banks. So big companies, just all different types of institutions are in there. And so with that little bit more risk, you get more return. And the fact that you can access that market without having to be an institutional type investor or a pension fund or something is what this fund does. And that's really interesting right now as interest rates fall, expected to fall, I should say, and people can squeeze a little bit more out, as you say. So the next three are quite interesting to people in terms of they're probably, these next three are probably things that I would say are more enduring for people, Hugh, in that we're going to talk about cybersecurity, we're going to talk about gold and India, which are three things that a lot of people talk about in our community in terms of investment prospects over the next while, whether that's in their satellite portfolio, like off to the side, or whether it's a slither of their core portfolio in the case of gold. You and I have spoken a little bit about HACK before. HACK is the ticker symbol. I really like the ETF for what it's worth. And I think it's definitely got a place in a lot of people's portfolios that can see the long-term trend. They don't need to be cybersecurity experts. Talk to us about this. And then I'm really interested to get to gold. But talk to us about like the cybersecurity kind of trend in society and what that means for people listening.
Yeah, so I think we all know cybersecurity and what it is. You know, we used to have a old ecosystem where it was about Trojans and malware, etc.
Yep.
But we've seen, a lot of different developments out there, such as, just geopolitical conflicts between, major nations, the advancements of AI technologies. That's really increasing the rate of cybersecurity attacks that are happening. And so what we're seeing is that businesses, they're looking to, spend on high quality software packages that leading companies can provide. So companies like CrowdStrike and Palo Alto, which are two of the top names within HACK, they've done extremely well. And yes, there are a breadth of different cybersecurity companies out there. But anecdotally, I have a friend who's working in the cybersecurity space in Australia, and what they're seeing is that they're looking to consolidate their software packages into maybe one or two leading providers because they can consolidate their costs, they can manage how much they're spending. That's a general trend that we're seeing, not just in Australia, but also in the US as well. And another point to add is that as the industry continues to evolve, we're seeing, more layers of products being developed. So things like SOAR, which is SOAR, that just stands for Security, Orchestration, Automation, and Response. It's a very long term, but what it does is essentially it acts as an AI assistant. So you might have what we call low-level security alerts coming into your enterprise system. It might just be a bug or a phishing email, and so that sort of source system, it will do all of that work for you so that you, as a cybersecurity analyst, can focus on more of the higher level security alerts that you're receiving. So you can add more value to the business from a security perspective.
Interesting.
And another area is IAM, or Identity Access and Management. With the rise of deepfakes, you can copy the faces of other people using AI technologies. And what IAM software can do is that it can sort of read and determine whether that image is fake or whether it's generated by AI. And so we're seeing a lot of developments into that sphere as well. Okta is a company that is within the IAM space, and it's another company within HACK as well. So generally we're seeing a lot of spending happening within cybersecurity. So there was a Morgan Stanley research, $260 billion expected of spending in 2025. And cybersecurity within the broader IT ecosystem, it's a very resilient part of enterprise budgets, because if you're looking at where you want to cut any spending out of your budgets, it's not going to be cybersecurity. You're likely going to keep that within your business because you don't want to run the risk of anyone infiltrating your systems.
Yeah, sorry to all the marketing people out there, but it's often marketing and sales and these types of roles do get cut first before those critical elements. It's interesting you mentioned about the deep fakes. I often think about that with my phone and like how literally everything in my life now goes through. Is it Face ID on my Face
on
the
ID,
iPhone?
Yeah.
It like scans a face. I'm like, what happens if like you see in the movies where they hold the iPhone up to someone's face in like an action movie or someone that's passed away?
Or even a picture and you put it on the Face ID and it just works sometimes.
Yeah. So like that freaks me out because I'm like, people could literally do anything. I have like 50 different bank accounts tied to my Face ID. But you also mentioned Okta there. That's a really interesting company. If people are familiar, if you go to log into something and it's got SSO or it's like single sign-on, that's an example of Okta in action. And basically acknowledging that the weakest spot in a security system is typically the user and then putting the same password for everything, which is basically me.
And me too, yeah.
So like if you can sign on once and you can do it securely, it applies to like the whole system. It gives you access. That's really, really interesting. Now there's two more here, Hugh. This next one's quite interesting to me because I've been thinking about this ETF a lot, not just this year, but also late last year, which is the QAU ETF, which is gold focused, but it's a leader in something that it does that has an overlay on it, which you'll talk about, I'm sure. What it does is quite interesting. We're talking off air about the amount of money that's flowing in, as like you mentioned before, the flow of money is a good indicator of what's actually happening. Talk to us about QAU, that's the ticker symbol, what it does and why you think it's quite interesting.
Yeah, so QAU is our gold ETF. Now, the nuance with that is it's the only currency hedged gold ETF. So it will hedge back all the assets back into Australian dollars.
Yep.
Now, gold as a asset class or theme has done extremely well, and it's something I'm very excited about. I was talking about gold, and even just Betashares in general. We actually have that within our own managed accounts, and so we've taken a slight overweight to gold, in recent months. And there are a number of different factors as to why gold has done extremely well. It's nearly at $3,000 US per ounce. The first one is central bank buying. There was the latest World Gold Council full year report came out, and what they showed was that central banks bought 1,000 tons of gold in 3 consecutive years from 2022, 3, and 4.
Wow, 1,000 tons.
1,000 tons. That's a lot. If we think about the 10-year average from 2010 to 2020 or 21, the average was 500 tons.
Right.
So we can see a huge amount of central bank buying, and that was really catalyzed by the developments in 2022 when the West froze Russian assets. They had about $300 billion of assets frozen by the West, and what that sent to the market, particularly emerging market central banks, they were like, well, if the West can freeze Russian assets, might be able to do it with my reserves or my assets. So since then, you've seen central bank buying increase, and they're led by countries like Poland, Turkey, India, and China. So your EM countries.
Yep.
So that's the first big one. The second one is probably just geopolitical conflict in general. We're seeing a lot of uncertainty, even starting back in I think 2023 when Hamas and the Israel conflict emerged. But throughout that period, there's been a lot of uncertainty in terms of trade, tariffs, etc. And when there is uncertainty in the market, gold is seen as a good hedge against any of that uncertainty. And so that's another tailwind. And then other factors like the rise of AI and technology, gold is used to build different circuits within computers as well. That's another channel that can increase the gold price. And flows into gold ETFs is another one that can bolster the gold price.
Yeah,
so
it's more buying activity.
Yeah, more buying activity. So all of those factors have culminated into a really sustained rise in gold. And then maybe a few other factors are, things like interest rates and a weaker US dollar. If we do see interest rates come down, which we do expect, and we see the US dollar also decline as well, then that should support the gold price as well.
So 2 quick questions. One is, you mentioned that you, here at Betashares, you have your own managed accounts where you design the portfolios for financial advisors and do all that sort of stuff. I'm asking for this off the top of your head, so totally get it if you take this one on notice, you. But just roughly speaking, how much of a balanced portfolio is typically allocated to gold? You don't have to take that from your portfolios necessarily. It could be like just anything, but like roughly some context around how much people tend to put it in their portfolios.
Yeah. So I like to, when I talk about gold, I like to bucket it into asset classes. When you're building a portfolio, you should think about the asset classes first and then delve into the sub asset classes. So maybe if we think about, a balanced portfolio, you might have an alternatives asset allocation, and within that you might have some gold. Generally, your alternatives allocation within a balanced portfolio is not going to be as high as it was in a high growth portfolio. You could say 5% within the alternative sleeve, and within that you might have gold. But if we take a high growth portfolio, let's say your alternatives sleeve is about 10 to 15%, you've got a bit more that you can allocate to gold. So because there are different asset classes within different sub asset classes within alternatives to consider. But generally, gold wouldn't make a majority of your portfolio. It would make up a relatively small portion of your portfolio. And because, as I said, it generally acts as a hedge against any economic uncertainty or stress in the equity markets.
Yeah, so effectively, for people's understanding, a lot of professional investors have this thing called alternatives. You'll see it in your super funds, and that could be double digits or it could be single digits, and then within that you can have a little part for gold as well, and that's kind of the bucket that it sits in. That's really interesting. And the second point is probably not so much a question, it's more just for people's understanding, is this ETF is currency hedging. And you mentioned the US dollar price of gold. All gold in the world is traded in US dollars, and it's around about $3,000 an ounce, if I'm not mistaken.
2,900.
2,900, say, at the time of recording, right? But if you convert that to Australian dollars, it's significant.
Yeah.
So what this ETF does is it actually controls for fluctuations in the ETF against the US dollar. With the US dollar being so low, or the Australian dollar, sorry, being so low against the US dollar, that's what makes this really interesting right now. And I'm already watching this really closely. I know it's a bit technical for some people, but basically what I mean to say is you can get like the gold return, the price, but if you use the currency to your advantage, you can actually benefit in other ways.
Yes.
So that's something that people should consider. Now, Hugh, our final one is what you've categorized in an email, at least this is what I've got, as an emerging giant. Okay?
Yes.
So we're going to be talking, in terms of the theme, we're going to be talking about India, but in terms of the actual ETF that we're talking about and talking around is IIND. So India, it's a big place. There's a lot of people. It's a big economy now. How do we break that down for people in just a few minutes?
In just a few minutes. Yeah. So India, as we know, very large country. There's a lot going on in terms of business reforms. The average age of the population is very young as well. So we can almost think about India like China was, a few decades ago. And it's one of those countries that is experiencing economic growth rates above 6%. And you're not going to find that anywhere else in the world. And we do know that over the long run, strong economic growth typically will support business profits, and that will support the local share market. And I mean, I think another thing as well, and why we've really picked India, so IIND, the Indian Quality ETF, that's our fund, is because, we've entered 2025 and the headlines are about tariffs and which countries are going to be affected. And we know those are going to be countries that have a large amount of goods exported to the US. So that's China, Mexico, China, Mexico, Canada, etc. And possibly the EU as well. When we think about India and the exports they go to the US, it's predominantly services based. So think about IT consulting, business improvement services, etc. Those aren't goods; those are services. So that's going to be less affected generally by Trump's tariffs policies. So you've got this almost shield that's happening underneath the surface, and then you've got this underlying growth story that's picking up in India as well. And so, the Modi government has set aside a portion of the country's GDP in order to just build infrastructure investments. So think about national highways and airports. There was an interesting stat where the amount of airports they've built have increased quite tremendously as well. So there's a lot going on for India. Yes, there's a lot of headlines actually, that India might be experiencing a slight economic slowdown, and that the equity market as well has slowly come down since September 2024. I just want to address that sort of maybe concern for investors. We still think there's a long-term structural theme here. There is a slowdown for a couple reasons. Inflation is relatively high there. That might be hurting consumption within India as well. And they've just had an election too, and that can generally provide a seasonal downtrend in the amount of spending that happens. But, longer term, the story is still there. You've got a young population, you've got a lot of investment, and foreign direct investment is also being encouraged as well. And so, we feel that India is a place to be. Now, with our fund, it's a India Quality ETF. So similar to AQLT, we want to filter for the companies within the Indian market that have a quality bias. So in a similar way to AQLT, we'll still hold a lot of those large names within India. Think of, the banks like HDFC Bank, ICICI Bank, etc. But we will sort of tilt the portfolio towards those high quality names. There are also companies like Infosys in there massive. As well, Tata Consultancy. So they do a lot of IT services.
They sponsored the Australian Open recently.
Yeah, they did.
Yeah. It had to be a big business to do that.
Yeah, absolutely.
So we've got 5 of these, I guess, trends or themes or however we want to think about them. We've got the Australian quality as like a sub-theme almost of like the Australian market, in that it's kind of like you could just buy the index funds, or you could be a bit smarter in there and kind of just focus on the companies that you kind of want to weed out as more higher quality, more durable, I would say.
Yes.
Number 2 is your headline, Cash Ain't Trash, with MMKT, which is just an extension of like people will have, like we have a lot of AAA, the ETF in our portfolio. And so I've naturally looked at this ETF a lot as like, well, how do we squeeze a little bit more of cash for retirees and that sort of thing? Really, really popular there. Number 3 is kind of the cybersecurity, which to be honest is probably, they say not to have favorites. It's probably my favorite Betashares sector ETF, if I'm being honest, because it's got a really good track record. It buys great companies. Like I owned Okta, and just as an FYI, our Okta shares tanked after I bought them. So I just wish I bought the ETF. Like honestly, I've thought about that for like 2 or 3 years now. I still think Okta's a great business run by a great founder, but the reality is I should have just bought the ETF. Number 4 is gold, and in particular currency hedged gold with QAU. Number 5 is this emerging giant, which is India. You mentioned some of the risks there, obviously. That comes with the terrain. But across the portfolio, there's a lot of different ideas here that people can pursue. And what I would highly encourage everyone to do is go to the Betashares website and actually just read the literature. There's like fact sheets, which are more like monthly updates. And then there's the literature, which goes along with each of the funds, as well as the PDS and all that legal stuff. But the literature is like the blogs and the articles and those types of things that go along so people can properly understand what they're buying. If I was to pick my favorite, obviously I just mentioned Hack is probably overall favorite, but excluding that, I would probably say right now, I'd be tossing up between QAU and AQLT, to be honest with you. The reason why QAU is a bit boring for people that just want to buy some gold and put it in the bottom drawer, but I actually think it's really interesting with everything that you've said, but also the currency aspect. I think our currency may be even undervalued a bit. So, but I think AQLT, if people are looking for a way to complement in their core portfolio, I think that's a really, really cool thing. One of the things we haven't spoken about is just the risks involved in investing. Obviously, there's always risks. So people should just be familiar with those. And I'll call them out. Like the PDS is a great place to start. Obviously, check out all the literature and just maintain that balanced portfolio through time. You've probably got the sense, if you're watching this or listening to this, that you can have a portfolio of ETFs that is diversified, but also exposed to some of the world's trends that are going to shape how we live over the next 20 years. So keep that all in the back of your mind. I will just say, if you want to learn more, Hugh does a lot of great things, but in particular there was a couple of articles that you did for 2025 and beyond. I can link to some of those. Some of those are kind of for advisors only, but some of them are able to be read by just anyone. So I'll put a link in the chat on how to get access to those. There's reports, there's resources, mate. We've covered a lot of ground in this episode. So just want to say thanks for inviting us up into the office.
Thanks for having me.
Thank you for joining us again on the show.
Thanks, Owen. Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.